One of the key topics you guys have heard me talk about before is the whole area of company-sponsored pensions. And I talk about these because they are a fantastic wealth accumulation tool, and they are fantastic because of the tax breaks. So before I get into the differences between the types of pension funds that are out there, let me just briefly explain what a company-sponsored pension allows you to do. Whether you're an employee of a company or whether you're the owner of that company, these tax breaks apply. So what a company pension allows you to do, or it allows your company to pay money into a vehicle for your benefit and claim that payment as a tax deduction. Not only can the company claim it as a tax deduction, when that money moves from the company to the retirement fund, the money now belongs to you. So the ownership is transferred from the company to you, and you pay not a single penny in tax on it. Not only that, but that transfer takes the money away from the creditors of the company. So for business owners, it's a risk mitigation tool as well as a tax planning tool. On top of that, as soon as the money is in the bucket, as it were, you make an investment. The investment is exempt from income tax and exempt from capital gains tax. So let's put that into simple arithmetic. 10 grand. 10 grand is coming to you from your employer. You take it as salary, you get 5 grand, roughly. You invest that 5 grand, you make 10% a year, you get to keep 5% a year. Compare that to putting the same money in a retirement fund. You don't get 5 grand, you get 10 grand. So your wealth is doubled overnight in that example. You make 10% a year, you get to keep 10% a year. So as a vehicle that allows you to use company money to build personal wealth, it is by far the sharpest tool in the box for those tax reasons. Now, while there are many different types of pensions out there, I break pensions down into 2 categories. One is off-the-shelf pensions. These are the vehicles sold on the high street by Irish Life or New Ireland or Aviva or Standard Life or whoever you care to mention. Sold by agents remunerated by those insurance companies to sell those products to you. So they're one category, and we'll call them off-the-shelf pensions. The other category is self-administered, or what I sometimes refer to as private pensions. So what's the difference? Well, let me tell you a few things about off-the-shelf pensions you may not know. The first thing to tell you is when that 10 grand leaves the company and goes into the Irish Life or New Ireland or whoever high street pension fund, you're not an investor in that company. You're a creditor of that company. So what that means is the money doesn't transfer ownership from your company to you. It transfers ownership from your company to the insurance company. And the problem with that is that because they own the money legally, effectively they can charge what they like and not have to tell you about it because it's not your money, it's their money. The second thing to tell you is there's no independent accounting of the funds, the investment funds that these companies offer you. So for all you and I know, they take our 10 grand, they make 20% a year, they give us 5 and they put 15% in their back pocket. I'm not saying they do that. What I'm saying is we can't see whether they do that or not. The third thing to say is those funds have names for charges, 2 different names for charges. And the difference is some charges are the ones they have to tell you about, and some charges are the ones they don't have to tell you about. Explicit charges is what they name the ones they do have to tell you about. Look at your policy document if you have one of these. You will see these charges. The annual management fee, the monthly policy fee. Simple charges like that. Implicit charges are the charges they don't have to tell you about. They're the charges that they pay brokers when they're dealing with stocks and shares. There's the bonuses and remuneration they pay the fund manager. They're the legal fees they pay when transacting different purchases, be it property or stocks and shares. So you have a whole bunch of charges you do know about and a whole bunch of charges you don't know about. And the final thing from an investment perspective is they offer you own brand. So if it's Zurich, you're the Zurich 1 fund or 3 fund or 6 fund, the Irish Life Blue one, the New Ireland Green one, the Royal London Purple one. But its own brand. Very narrow set of investment opportunities. So that's your off-the-shelf pension. Now let me compare that to what I've referred to as the self-administered or private pension. When you put the 10 grand in the private pension, you don't transfer ownership of money. The money is held in custody for you. So you're not a creditor, you're an investor. Not only that, but under revenue rules in Ireland, private pension funds must produce a set of independent accounts every year. So an independent agency is going in once a year, looking at your fund. Here's what you put in. Here's what you made in terms of returns. Here's the fees you paid. Here's the end result. Complete transparency. From a charges point of view, the charges for establishing the fund are charged to your limited company. They're not charged to your pension fund. They're not coming out of your pot. They're charged directly to the limited company. So you know exactly what they are because you get an invoice for them. Not only do you get an invoice, but the invoice is offsettable against corporation tax, and the VAT for VAT-registered businesses is offsettable or reclaimable in the normal fashion. And then finally, the thing to tell you about investments is it's easier to tell you what this type of pension fund can't do than what it can do. What it can't do is buy product from you, or buy product and let it to you or your business or your mum or your dad or your uncle Tom Cobley, or your wife's or husband's mum or dad or uncle Tom Cobley. Self-investment, the revenue call that. The second prohibition for these funds is what the revenue refer to as pride and possession items. Fine wines, classic motor cars, racehorses, all arguably investments, but under the pride and possession prohibition, not allowed within the private or self-administered pension fund. I used to do the ISME business briefings years ago where I think it's around January, they travel around all the various regions and they bring a number of speakers. I shared that platform years ago with a gentleman by the name of Clive Slattery. And Clive at the time was head of the Retirement Benefits District of the Revenue. And he used to talk about these pride and possession rules. And his example was the revenue lie awake at night worrying about you driving around in half your pension fund, drinking the other half. So classic motor cars and fine wines, not allowed. The final icing on the cake, so comparing these two types of pension, one offers complete transparency, one offers complete ownership and control, one offers a much broader investment spectrum. And the final icing on the cake, as I said, is that inside private retirement funds, you can borrow money to buy property. Not only can you borrow money to buy property, but if you do so, borrowing within private retirement funds is on what is called a non-recourse basis. That means that the bank lending you the money can only take the asset it's lending against as security. It can't touch your other pension assets. It can't come after your personal assets. So if you compare that to borrowing money personally, when you and I borrow money personally, everything we own is put at risk. Our house, our car, our pension fund, everything. You borrow money within a private retirement fund, only the asset being purchased is put at risk. So it's far safer when borrowing money to create wealth to do so within a pension fund than outside. So all of this debate that goes on about fees and commissions and all of that, it's worthy of discussion. But what is vitally important to know is the different legal structure. If I'm going to put large amounts of money in my pension fund, I want to know I own the money. I want to know that there's a complete transparency of costs. I want as broad an investment opportunity as possible. And where possible, I want my company to pay the fees rather than my pension fund. And if you want that too, then you need a self-administered fund, not an off-the-shelf one. You've heard me say it before, but off-the-shelf pensions in Ireland, the ones available on the high street, have been built for Mr. Average. Now, they're fine for Mr. Average. I was having this discussion with somebody last week, and he told me about a brother-in-law who worked for Aviva, and the guy saying, well, at least we offer poor people the opportunity to diversify and invest in products and services they couldn't get if they weren't buying them through Aviva. And that is true. My problem is when somebody in our cohort, when high earners approach Aviva, they're not told, by the way, this product isn't for you. Go off there and find a self-administered. They're sold exactly the same product. So off-the-shelf high street products are built for Mr. Average. Mr. Average in Ireland is 47 years of age, has 2.3 children, half a dog, and a mortgage he's going to pay off when he's in his early 70s. Now, if that's you, then off-the-shelf pension funds are perfectly fine. But if that's not you, you need to look at the alternatives. You need to look at self-administered so that you can get a product that's designed for high-income earners and those with high net income wealth rather than those designed for Mr. Average.